Bismillahirrahmanirrahim. Today we will discuss the profitability ratios. These ratios basically measures a firm's profitability position by using the data mainly taken from the income statement, and for few ratios also from the balance sheet. These ratios are very helpful for creditors, taxation authority, stockholders, and for the potential investors. Important profitability ratios are gross profit margin ratio, operating profit margin ratio, net profit margin ratio, earning per share, return on assets, and return on equity. Today, first we will discuss the gross profit margin ratio that measures the percentage of each sales remaining after the firm has paid for its goods, and its formula for calculation is the gross profit divided by sales. In the income statement, when we calculate the net sales and then we deduct the cost of goods sold from the net sales and get the figure of the gross profit. Here we are taking the gross profit, this is the 50 lakhs, and the sales it is 8 crore. So by the division we are getting the figure of gross profit margin ratio, this is the 62.5%. It means out of 100% sales, the 62.5% is the gross profit margin, and from this 62.5%, now the remaining expenses and cost will be deducted. So the higher value of this ratio is always desirable. Next is the operating profit margin ratio that measures the percentage of profit remaining after the firm has paid its cost of goods sold, marketing and journal and administrative expenses, and its higher value is also desirable. It means after the gross profit, we will deduct all of the marketing and journal and administrative expenses, and we will get the figure of the operating profit. Here we have the operating profit of 40 lakhs and the sales will remain the same. After division, we get the figure of the 5%. And now from the 5%, we will deduct all of the other expenses. It means the sales is the 100% and the operating profit margin is the 5%. Also, its higher value is always desirable. Next is the net profit margin, measures the percentage of sales after the firm has paid of all of its cost, expenses and taxes. It means the operating profit, that is the pure profit, because we have purely obtained from the operation. Now from the operating profit, which is also called earnings before interest and taxes, we will deduct the financial expenses and the government taxes if the government has imposed. So after this deduction, we will get the figure of the net profit or the net income, and we will divide it by the sales. Here the net profit is the 30 lakhs and the sales is remaining the same. So the net profit margin ratio is 3.75%. It means if the sale is 100%, the net profit margin is 3.75 after the payment of all of its cost of goods sold, after the payment of all of the marketing and administrative expenses and financial expenses and the government taxes. Its higher value is always desirable. So these were the first three profitability ratios. The remaining, the return on assets, return on equity and earning per share, will be discussed in the upcoming lecture under the title Profitability Ratios Part 2. I hope you will like it. I will wait for your valuable comments. Thank you and Allah Hafiz.